Let's look into American Tower, and we want to find the discounted cash flows of this company and find the intrinsic value of the stock and see if it's worth a buy or not. So the market cap is 101.14 billion, 108.14 billion, and the stock price is 243.93. So they have 443 million shares outstanding. So we need to estimate the future free cash flow of the company and then discount those cash flows with the appropriate discount rate. And we could find the value of the entire company and then divide that amount by 443 million, and that'll give us the stock price. And if we calculate a stock price higher than what they're trading at, we consider this a buy. And if we calculate a price lower than it's trading at, we consider it a sell. So free cash flow is what's left over after operating the business. So this is what analysts use to calculate the value of a company, because it's actual cash that's going in or out. There's no accounting going on that could alter the numbers. So about 2 to 3 billion a year in free cash flow. And net income is also positive, so that's good. And revenue, it seems like it's been going up each year, which is good. So the numbers look pretty good so far. They look fairly consistent. So let's look at that capital structure. We want to see how much we have to discount the cash flows by, because every company borrows at a different rate. It's kind of like when you get a mortgage, you get probably a different rate than a friend or family member, because it's based on your credit score and your prior history. So they have $814 million in interest expenses on the debt. And let's see how much debt they have. So current debt, 2.9 billion. And then long-term debt is 21 billion. So they pay 3.38% interest on the debt. And now we need to find their effective tax rate. So they're a REIT, so they, I think, pay really low taxes, because when they distribute 90% of their income to their investors. So let's use this year, because it's just weird that they're paying negative income taxes, so they're getting a refund. That's why sometimes it's hard to look at the income statement to get a true picture of the company, because there's a lot of accounting things happening where some expenses are getting put in here that were from prior years, or losses are being used for this year that happened 10 years ago. That's why cash flow is a really good indicator of things. So even though they pay 3.38% on the debt, we have to discount it, the effective tax rate. So they actually cost them 2.92%. So let's look at what the beta is, because that's a really low beta, 0.43. So that's a pretty safe stock. There's very little volatility. So the cost of equity is 5.62%, and we use a capital asset pricing model to figure that out. And the WACC, which is the weighted average cost of capital, when you blend together the debt and equity, is 5.13%. So we have to discount the future cash flows by 5.13%. That's a pretty low discount rate. And we calculated the future free cash flows. We did a terminal value at the end, which calculates all years after this, because we can't do this forever. We have to usually end at some point. And we discounted those cash flows to today's dollars. And the sum of these amounts is 132 billion. So that's what we say is the intrinsic value of this company. And now if you divide that by 443 million shares, we estimate the stock price at $299. And if you look at the historical stock price, it's pretty close to that. looks like maybe a month ago it was probably around 260. It did drop off. It looks probably around coronavirus when that hit in March. So it's trading at a slight discount, a 19% discount. So we consider this a buy according to our model. So this is really interesting how close it is to the actual stock. But let me know what you think in the comments. Do you invest in REITs? Have you invested in this particular company? Let me know what you think, and let me know if you want me to do another video of a different company. Thanks for watching.